Okay folks, welcome back to Pete's Investing. It's February 27, 2024. This is the Bitcoin analysis, including some ETF reviews. Now on this one, we've got the bullish trend currently in the with new highs being reached, and well, not new highs overall, but new highs more recently in the last few months at least. And there is a divergence, a bearish divergence to look out for, so just be careful about going long aggressively. Also, we're going to look at a new indicator added, which helps identify tops and bottoms. And I'm also including a trading idea at the end of the video, so stay tuned for that one in the coming few minutes. So first off, in terms of some quick news, cryptocurrency has surged on Monday with Bitcoin topping 53,000 for the first time since November 2021. Ethereum, Near Protocol and Coinbase all saw significant gains, fueled by positive developments like Ethereum's upcoming upgrade and overall industry optimism. Bitcoin miners benefited from the price rise, and Coinbase is positioned to ride the wave and due to its diverse crypto offerings. This rally suggests the crypto winter might be over, with increased activity, valuations and development boding well for the future, especially for blockchain offering real utility. I'll first go through the charts summaries overall before I get stuck into the trading ideas. So first off on Bitcoin, we can see you've got the weekly, daily and hourly. I'm showing that on each of these instruments I'm going to go through. Now overall, we've got a bullish movement on the ADX 25. It's on the weekly, the daily and also on the hourly. So bullish, bullish, bullish. On the CCI 150, our divergence indicator is currently trending in line with the price. No divergence in place. We did have a massive bearish divergence there versus those highs on the price, and actually the price fell off, so always pay attention to divergence, and they can apply on any time frame. On the daily, likewise, we've currently got a bearish divergence on the CCI 150 versus higher highs on the price, and on the hourly, likewise, we did have a bullish divergence back here versus the double bottom on the price, and the price actually went sideways before it spiked, so that would have paid off nicely had you traded that. Now as well, I've also got this, let me just zoom out a bit on this one. You'll notice here I've got these red arrows and blue arrows that they indicate potential highs and lows, and most of the time they do indicate those high and low peaks. With the exception of these little areas here, you can see there that's showing a decline. Now I like to use those especially in conjunction with a divergence, and that was telling you basically be ready for a decline, and eventually did. Now I'm not suggesting you go short here, but just be careful about going long. Now you can see there that it eventually broke down and showed you some long positions, and that broke higher. So that would have been your first, if you drew a divergence up from those peaks there to those highs, that would have been your first decline down to that point. Now again, there's no bearish arrows showing there off that resistance at 54,920. So that could actually break higher. Again, it doesn't always show red and blue arrows. Sometimes it misses out on those. So just giving you, this is just in probability. It helps you identify peaks and troughs in some of these areas. Again, no red arrows on the hourly, nor the weekly as well. So just be careful about about going short at the moment, although there is a resistance showing there. Next, we're going to look at the ProShares short and BTI strategy, which is ETF, BITI. This paint, so you can see here on the weekly, bearish momentum on the weekly with the price moving in that direction. There's no CCI in that one. Bearish on the daily, although we've got a bullish divergence, you can see there, versus the price, and bearish also on the hourly. There was a bullish divergence here. Price bounced somewhat, but then it fell further. So they don't always work, so just be careful about using those as just again, it's another probability to look out for. And it hit this support level at 985. Next we'll look at Marathon Digital, which is MARA. Okay, we've got bullish momentum on the ADX, bullish on the daily and bullish on the hourly. The CCI 150 is showing no divergence on the weekly. There is no divergence on the daily and no divergence on the hourly. There was a bearish divergence back here, and the price fell off. Now it's showing a bullish arrow, which showed a bounce from there as well. Back on the daily as well, we showed a couple of bullish arrows there, and some negative and some bearish arrows up there as well. Normally with these, I like to see a few clusters of arrows, which indicates a more higher probability of decline or a rise. You can see there are a big bunch of red arrows, and it fell off, and a couple there which failed to rise, but a couple there which rose. A single arrow there, then a few arrows there. So again, just using it in clusters would be preferred, especially in alignment with a divergence. Riot blockchain, RIOT. So again, this is showing bullish movement on the ADX on the weekly, bullish on the daily, and bullish on the hourly. The CCI 150 is showing no divergence. There's no divergence on the daily, and there's currently no divergence on the hourly. There was a bearish divergence back here in that little period there, and it fell off. In terms of a trading idea, this is back to the Bitcoin chart. I've got the weekly, daily, and hourly. I do cover the 3 different time frames because depending on what time frame you want to trade, I do show the higher time frame. So for example, if you want to trade the hourly, you'd be wise to at least follow the daily trend. Now you've got the ADX down here, which adds more credibility to the trend, which means at the moment we're going long, for example. And down here it's also showing a long position on the ADX. But the trading strategy I'm going to show you really depends on where this CCI 150 breaks above this wave of moving averages. And I've got that video to draw this indicator in the description below, so reference that. But basically on this one, you would go long when the CCI 150, that black line, breaks above the blue line. If I zoom in, you can see there, so you'd start going long on that candle there, where the CCI breaks on that candle, where the CCI breaks above the blue line. That's probably a bit too early because it could actually continue to turn down or go sideways. So to be conservative, start going long at that point there. Now that, again, the ADX only adds credibility to that long positioning. Okay, you can still do it on the when it's showing short. I'm just trying to find an example. It doesn't show you any examples here, but basically when the ADX is showing long positioning, that's where you take a long position. Now that's showing this is showing the daily. So let me jump to the charts where we look at trading on the 1 hour time frame. So the strategy is very simple, using Heiken Ashi candles. So most charting software allows for Heiken Ashi. So this is a Heiken Ashi chart for the Bitcoin price on the hourly chart, and I'll go through the strategy. So basically, whenever the Heiken Ashi breaks into a long position, such as for example there, you would go long, and you get out with a minimum of 0.06% gain. And I'll say 0.06 instead of 6%, because when you're trading the lower time frames, you aim for a smaller breakdown of that percentage gain. If you're trading the daily, you'd aim for a nominal 3, 4, 5, 6%. But here we're looking at a 0.06% gain, and we don't use a stop loss in one strategy, and I'll explain the difference between a stop loss and a averaging down. So in this case, if we get caught out going against us, we average down when it goes against us by at least 3% drop, and we enter again when the Heiken Ashi turns long, such as in this case there, for example. So let's say, for example, I'm trying to look at some examples here where you might have gone long there. It may not have gotten out with enough profit, and now it scrolls down, it actually averages down, and you would have entered another lot of shares when it broke above there, for example, if that was a good 0.03% drop. Sorry, yeah. Now, and the exit is a 0.06% gain. Now, the other strategy is with a stop loss. If you choose to use that, that's fine. You get out with a 6% gain, the same entry exit parameters, but you stop loss with a 0.03% loss. Okay, so let's look at what that looks like in using backtesting results. Okay, here we have the 3 charts. So we've got the daily on the left here. We've got in the 2 1 hour charts. This green chart shows long positions only at the moment, and so does this one, shows long positions. The difference being this one has a stop loss strategy, and this one uses the average down, and it maxes out to 10 contracts if you want to use the average down approach. So we want to limit our potential loss or drawdown on our account, so I gave it a limit of 10. It only goes as low as or as high as 6 contracts in this example. Now what I'm demonstrating is, again, as I said earlier, when it breaks above the CCI 150, it breaks above the blue line there on that candle, that's where you go long. So what I've done, I've applied a date parameter, which happens to be on that candle. You can see there on the right with those grey vertical bars. That's where both of those trades start. Now with this one using average down, trading the Bitcoin price from that period, it generates $8,181, and this one generated $1,300 using the stop loss strategy. So again, depending on what strategy you use, this doesn't average down. It only trades with one contract each time. This one goes as high as, in those cases, it went as high as 6 contracts before closing out the trade. There are a couple of single contracts there, and a couple of times it went as high as 3 contracts there. Also, strict rule is when this CCI 150, again this on a daily, when the CCI 150 drops and touches or breaks below the blue line, that's where you should stop the long positioning. So you can see there on the charts, on the 1 hour charts on the right, the 2 right charts, those vertical grey lines, on both of those instances, you would have let the program, or you let the trade run, and you would have closed out the position after that closed its trade there. And on the other one, on the stop loss strategy, somewhere around there, you would have stopped trading that around that period there, because you don't want to get caught going long when the price is potentially declining. So again, you would have gone long there when it broke above the blue line, and you can see the vertical line there. It entered about 1 contract on each trade. Next, we look at the short positioning. So when the price breaks below when the CCI 150 there breaks below that red line, that moving average, you would have gone short there. Now notice that candle is the lowest candle, so why would you go short? Because you don't know what's happening in the future. But using the CCI as an example, you would have gone short there. So you can see there on the positioning on those vertical lines on the right, that you would have gone short during that period. You would have averaged down those 3 contracts there. Actually, you would have gone down to 6 contracts and a couple of small trades there, and you would have stopped out the trade after that position closed. Likewise, on the stop loss strategy, you would have started entering short positions around there somewhere, and you would have stopped it out again somewhere around there before the price started dropping off. So again, very strict rules. You must only trade when the CCI 150 is above, go long only when it's above the blue line of those waves, and go short only when it's below. Let me go back to another demonstration back here. So if we do a short trade when it breaks below the moving average over there on the 12th of January, you would have taken short trades only during that period on the daily, and you would have stopped trading when the CCI breaks above the moving average, the blue line there. So you can see there going short there. You can see there on the right side for both the stop loss and the average down strategy. That would have been nice little profitable trades, and you would have stopped trading when it broke above around that period, and you would have let this trade close out, and you would have let the trade there close out as well. But again, looking at the profitability, and I've put this through, this back test runs the whole period. Don't let that fool you, because in this case that worked nicely, but sometimes you can get caught out and actually hit your drawdown quite seriously. So avoid trading when it starts breaking to the upside. But on this little short trade there, between the same date range, the average down approach generated 16,700, and the stop loss strategy generated just is currently still live around about $900. So just be careful about trading against the CCI trend. Okay, so what I'm showing you now is I've gone back on the hourly. I've gone back to the earliest time frame in this particular period, and you can see there that goes back to July 23. So if I go back on the daily chart, July 23 is back here during that period. Now you'll notice I started off with a $100,000 baseline on both the longs and the shorts, and that allows for a decline in price, or a drawdown. It allows for the drawdown. First off, you'll notice the profitability on the longs, because it predominantly was going long, on the average down approach, maxing out at 10 contracts at any one time, was 70,800. If your starting balance was 100,000, so you made 70,000. On the stop loss strategy, you would have made 4,100, again predominantly because it's a long positioning. Now notice on the short side, again you're going against the trend and going against the rule of trading with the CCI 150. Your stop loss strategy is down about 5,000 from your baseline, and your average down strategy is actually maxed out and it's eaten up all your 100,000 account balance if you were trading the whole thing. But again, you would not be trading that if the trade is predominantly long. You can see there during that down period, that strategy there, if I just zoom in a bit, was actually not too bad during that small downfall there. So up till there, right up until that, before the increase started, you're doing quite nicely, and you were generating about $12,000 worth of returns compared to the same period on the stop loss strategy. You were generating 3,100. So again, avoid and do not trade short when the CCI is above the moving averages, and do not trade longs when the CCI is below these moving averages. I'm just demonstrating the effects of the drawdown should you do apply this strategy. So I'm giving you the options here just in terms of how to trade some of these. Hopefully you got value out of that. Hit the like and subscribe button, hit that notification bell. I'll also put the trading rules at the very end, but thanks for watching and see you in a future video.